91%. That's how much of your trading results come from something you're probably not even thinking about. Not your indicator, not your entry strategy, not the pattern you just learned from that YouTube video. Tharp spent decades researching what separates consistently profitable traders from everyone else. And what he found should make you question everything you're currently focused on. Only 9% of trading system performance comes from your entry and exit strategy. The other 91%? Position sizing and psychology. Let that sink in for a second. You've spent months, maybe years, hunting for the perfect indicator, the exact candlestick pattern, the one strategy that finally clicks. And according to the research, all of that work affects less than 10% of your outcomes. Here's the thing most traders get wrong. They think the entry is the edge. Find the right setup, nail the timing, and the money follows. But I've watched traders with mediocre strategies make consistent money. And I've watched traders with supposedly perfect setups blow account after account. The difference isn't what they're trading, it's how much. Let me show you what I mean with a scenario you've probably lived. Trader A has a 60% win rate with a 2-to-1 reward to risk. On paper, that's solid. Should be profitable over time. But Trader A risks 25% of their account per trade. They want to make real money and stop messing around with tiny positions. 4 losing trades in a row, which happens to everyone, and they're done. Account blown. Back to square one. Trader B has a 45% win rate. Worse by every conventional measure. But they risk 1% per trade. They can lose 50 trades in a row and still have half their account. They'll never have 50 losses in a row. So they survive long enough for probability to play out. Same market, same opportunities. One builds wealth, one destroys it. This is not financial advice. Your results will vary based on your own trading. But the math doesn't lie. So let me give you the framework I use. 3 levels of position sizing from basic to advanced. Level 1, fixed percentage. This is where most tutorials stop. Risk 1 to 2% of your account per trade. The formula is simple. Your risk amount divided by your stop-loss distance equals your position size. If you're trading NQ futures with a $300 max risk and a 10-point stop, that's $200 per contract at $20 per point. You trade 1 to 2 contracts maximum. This alone will save most traders from blowing accounts, but it's not optimal. Level 2, volatility-adjusted sizing, ATR-based. The market doesn't have the same volatility every day. On a quiet Monday, a 20-point stop might be reasonable. On an FOMC day, that same 20 points gets taken out in seconds. So you scale your position size inverse to ATR. Higher volatility, fewer contracts. Lower volatility, you can size up slightly. This keeps your actual dollar risk consistent regardless of market conditions. Level 3, Kelly Criterion, but fractional. This is what the hedge funds use. Created by a computer scientist in 1956, later used by Ed Tharp to beat blackjack and then the stock market. The formula takes your win rate and your average reward to risk and outputs the mathematically optimal percentage to risk. But here's the critical part. 28% of traders who used full Kelly went bust. Variable outcomes require fractional Kelly. Most use about 33% of what the formula recommends. This captures most of the edge while protecting against ruin. Now, here's where most traders trip up. They understand this conceptually, they nod along. Then they open their platform, see a perfect setup, and just guess their size. Or worse, they enter first and figure out position size after. That's how you get traders with good strategies who still lose money. The math is right on paper, but the execution is emotional. For futures specifically, and this is what I trade, here's the exact calculation. Risk amount divided by value per point. divided by stop distance in points equals contracts. $300 risk, $20 per point on NQ. 6-point stop. 300 divided by 120 equals 2.5 contracts. Round down to 2. You calculate this before you enter. Not after you're already in the trade wondering why you're down $400. I built a tool that does this calculation automatically. You set your max risk, draw your entry, and stop on the chart, and it tells you exactly how many contracts to trade. Takes the emotion and guesswork out completely. Links in the description if you want to check it out. But whether you use a tool or calculate manually, the principle is the same. Position sizing is not an afterthought. It's 91% of the game. So to bring this together, stop obsessing over the perfect entry. Your entry strategy is 9% of your results. Start with fixed percentage, 1 to 2% risk per trade. Graduate to volatility-adjusted sizing as you get more sophisticated, and if you really want to optimize, look into fractional Kelly. The traders who survive long enough to become profitable aren't the ones with the best indicators. They're the ones who sized correctly from day one. Now you know where 91% of your results actually come from. The question is what you're going to do about it.